Welcome to your weekly fixed income briefing, proudly brought to you by Eastern River. In this update, covering the 19th to the 23rd of May 2025, we unpack how bond markets across the globe have responded to a wave of fiscal uncertainty, shifts in central bank tone, and early signs of recalibrated investor appetite. Let's take a closer look at the trends that mattered this week. This week in the US, the Treasury market showed signs of renewed pressure as policymakers in Washington continued their debate over fiscal priorities ahead of the mid-year budget review. The 10-year Treasury yield touched 4.58% early in the week before pulling back slightly to close around 4.54% on Friday. A tepid 20-year bond auction raised eyebrows, with investors demanding higher premiums amid broader concerns about growing deficit projections. At the same time, murmurs of a potential rate cut later this year have resurfaced. But for now, the Fed remains firmly on hold. Across the Atlantic, European bond markets were more subdued. The European Central Bank adopted a noticeably cautious tone during its latest communication. While previous weeks hinted at additional rate reductions, this week brought a shift suggesting that further easing may be paused if core inflation remains sticky. Traders are now recalibrating their expectations, as Eurozone data points to uneven growth, with stronger than expected consumer spending in France but weaker industrial output in Germany. Turning to Asia, Chinese sovereign bonds remained stable, with the 10-year yield hovering around 2.29%, offering a haven for domestic investors amid an uptick in property market volatility. Meanwhile, in Japan, the Ministry of Finance hinted at potential adjustments to its issuance calendar as yield curve control continues to shape investor behaviour. Notably, Japanese pension funds were seen rotating slightly back into domestic paper, reflecting risk aversion driven by global trade developments. Emerging markets posted a mixed performance this week. Appetite for local currency bonds improved modestly, helped by a weakening US dollar and rising expectations of policy accommodation in developed markets. However, political unrest in parts of Latin America and energy price volatility in sub-Saharan Africa weighed on sentiment. While inflows resumed in countries like Indonesia and Mexico, others, particularly frontier markets, faced renewed funding pressure as debt service costs continue to rise. The corporate bond market experienced a divergence in sentiment. Investment-grade debt remained well bid, particularly in the financial and utility sectors, as spreads narrowed on expectations of resilient earnings. In contrast, high-yield names came under pressure, with credit default swap spreads widening as investors reassessed exposure to lower-rated issuers. On the municipal side, strong reinvestment flows from recent maturities provided support, with longer-dated muni yields falling slightly despite broader volatility. As we close out the week, it's clear that bond markets are being guided less by macroeconomic absolutes and more by evolving expectations. From central bank recalibrations to shifting political narratives, fixed income remains a dynamic space. We'll continue monitoring the opportunities and risks as they unfold. Thanks for joining us. This has been your Market Wrap from Eastern River. Until next week, stay informed and invest wisely.